Hi, this is Jim Koetting, and we're here for another episode of Speaking with Authority. Today I have Joe Lieberman. Joe is an authority on business. Not only does he know how to buy and sell them and structure them for sale, but he's actually done it with his own business, and he's been an entrepreneur himself. So he knows all of the ins and outs of buying and selling businesses. So Joe, welcome. Good to have you today.
Well, thank you so much. Hi, Jim. Thanks for having me.
Joe, can you tell me a little bit about, first of all, your journey as an entrepreneur and how you got to sell your business and just kind of that process?
Yeah, sure. So after college and getting my engineering degree, I knew there was one thing I did not want to do, and that was be an engineer. So I found a job that allowed me to do business development in the corporate world, saw the functionality and most importantly, this dysfunctionality of a large organization. And over time, I was able to downsize into my own business. And literally from the basement of my home, I started a digital marketing agency, a little bit of web development and advertising back in the mid 90s. We used to call it the Wild Wild Web, because that's when it started. And I grew that up 1 year at a time. And 15 years later, I had 15 people and a lot of sweat equity. We had done really well. I had a lot of fun, but I was exhausted, quite frankly. I felt like there was a huge transition ahead with technology, and I was ready to extract my wealth and transition into something next. So that was my first taste of exit. I had some support, but all of it was brand new to me. And I got exposed to just the ins and outs of negotiating, the documents required, the due diligence, all of that related to M&A. And when I exited from that company successfully, I decided that I really enjoyed it and wanted to focus my energy on consulting for entrepreneurs and leadership and focus more and more on the exit part of it. So that's how I got into the M&A world, and I've been doing that for many years now.
Well, let me ask you this. I think it's really fascinating. What's it like for an entrepreneur when they decide they want to thinking about selling? I mean, what do they go through? What's the reason they want to sell? Is it just they're tired like you, they want to get out of it, they're getting old, they just want to pursue something else? What are some of the main reasons why people want to exit their business?
Well, it's a great question, and it's one that I always start off with. In fact, clearly we want to know that a business is viable, but we also want to know that the seller has a plan. Because the last thing we want to do is work with somebody who is in stage fright, who really doesn't have a vision for what that next step is, because there's a lot of emotion that goes into selling your baby in the first place. And it's highly critical that you understand, or at least have an idea of why it is you want to sell. So to answer that question, it depends greatly on what stage that individual is in. Typical client, as you can imagine, has built and grown the business over decades, maybe 20, 30 years, had it in the family, passed over or down rather, or built it up over time. And so they're ready for that next chapter, call it retirement, call it playtime, maybe another career change. In my case, because I was as young as I am, even younger, I wanted to go on to a different kind of career. I felt like I had accomplished what I wanted to. So there's going to be pretty much those 2 points, I suppose, forks in the road.
I know this has probably never happened before, Joe, but have you ever ran into somebody who thinks the value of their business might be a little bit outside of reality?
Never. They're always 100% accurate. In fact, they always undervalue what they have built. It's kind of like going up into the attic and thinking you've got all those antiques that are signed by Van Gogh and it's worth a lot. And then you find out it's just newspapers. Yeah, it happens all the time.
How do you help them get to reality? How do you help them get to reality?
essentially, you have to review the financials. There's equations. I'm not going to go into the math of it right now, but there's standard methodology for valuing a business. And in fact, a certified valuation will do it at least a dozen different ways. But the common understanding is that you take your income after looking at it certain ways, like after taxes or before taxes, rather, after depreciation. There's certain things that you do to adjust for it. But let's take this net adjusted income and we apply it to what's called a multiple. Now, again, that is not the way that you value business, but it is a way to get an understanding of what the value might be. Because essentially, somebody's buying that business for the cash that it generates. Well, what's the cash? Follows very closely with the net income. You take that net income and you multiply it times a number. How do you come up with that number? Well, there's industry standards. Those vary significantly based on the industry, by the size of the company, by the types of customers that are served, whether it's recurring revenue or non-recurring, how much customer concentration there is. There's just dozens of reasons. So that's one of, just for example, the complexity I'm exemplifying of why an individual who owns the business might find it difficult to say it has to be worth this. And they need help and assistance. And obviously they believe that it's worth a lot sometimes.
Yeah, absolutely. Have you ever found that you've been able to get people more than they thought it was worth?
Yes, several times. And always were motivated to do that. And there's a number of reasons why that will happen. We need to tell a story to the right buyer about the opportunity for growth. Clearly, the value of the business is really worth what somebody's willing to pay for it and what somebody is willing to accept. So finding that right buyer is critical. And the right buyer is going to have what we call some sort of strategic fit. They're going to see that they can add more value to it than other buyers. So for example, corporations that buy smaller businesses do so because they have support that they can apply to it that will reduce the expenses. They have channels already in place where they can perhaps bring the products or services that company they're buying into the pathways that they've already built as a larger organization. They know how to magnify the results of the business that they're buying. That's just one example of a strategic buyer. And so, again, when we go back to this magic number I just talked about, this multiple, the strategic buyer is likely going to find more value in a business than, say, an individual who's just buying it for a lifestyle business or others that might fit that category. So finding the right buyer is really the trick, and then also telling the story about where the opportunities for growth are.
Got it.
And then obviously the negotiation. Sorry.
Yeah, when you're going through that, I'm just curious on the buyer side. How do you go about and find the buyers for a business?
Well, there are a number of ways to do that. It depends largely on the kind of business. At my organization called IAG, International Acquisitions Group, we have a very large database of over 20,000 active buyers that have indicated to us through what we call buyer mandates what kind of companies they're looking for by industry, by size, by cash flow, etc. So we know in advance how to proactively go out to these buyers. There are what we call portals where buyers are looking, and we know how to gain access to those. And then I guess a third category is that when we have the right kind of company, we will proactively reach out to who we think the right buyers are. And that will really depend largely on the kind of company. But there are holding companies out there that are always looking for what we call add-ons to businesses, depending on the industry. So, just give you a random example here. There are companies in the agricultural business. We have a livestock auction cattle company where they're helping sellers sell their company, and it's just a real live action auction. And there are companies that consolidate these or large organizations that have this in their portfolio. So we will reach out to them. And in this case, we have.
That's interesting. That's fascinating. But it's not like you just go and search on Google. You've got a database with 20,000 people who are really connected and looking for other businesses at any given moment.
Yeah, there's also, surprisingly, there's a lot of cash on the table, and there has been for years, billions of dollars. And this is beside
Wow.
just the individuals, where companies are in the business of buying businesses. And for those of us that are in the industry, we have that expectation and knowledge. So there's already, if you will, a built-in demand for certain businesses. And you can have the expectation that there will be at least interest, not necessarily the right buyers. So there's certain categories, for example, like anything that is business, service, cash, recurring, or even residential home services. So you can think roofing or HVAC, pest control, you name it, where there's a recurring client base, and maybe industrial services that are recurring with contracts to property management companies. Those are always in high demand, and you have buyers across the board in virtually every single category.
Fascinating, fascinating. Well, if you were talking to a business owner and they're just dipping their toe in the water of, I think I'd like to sell my business, what are maybe the top 1, 2, or 3 things that they need to start working on?
He's back.
I lost you there for a minute, Joe. Are you still
Yeah.
there?
Part 2. Looks like we're back.
So if somebody's going to sell their business, what are a couple things that they might be needing to consider to start that process?
So there are definitely a few things. One is, as I talked about earlier, are they really ready?
Okay.
It's never too early to prepare. Never too early. Because in the preparation stage, you're going to learn a lot about how your company is organized and what is required to go to market. So clearly, I think it's obvious you need to have your financials in order.
Yep.
Tax returns, just basic things about the P&L and balance sheet, and large organizations having the ability to dive into more detail of inventory and products and working capital. The larger the organization, the more financial support they're already going to have. But smaller companies are not always prepared to do this. They don't always track their revenues their financials in monthly formats. So that is helpful. And when we come in, we will have a whole process of what we call engagement, and we'll prepare them for valuation. We'll go through the valuation process. We will prepare what's called an offering memorandum. And this is
Okay.
the confidential information that is sent to buyers after they've been vetted, and we have confidentialities in place. So the offering memorandum is the basis for disclosing a large amount of information to buyer prospects and companies that have bought other companies, individuals. That's what they expect. So that document, the umbrella word is offering memorandum, is something that needs to be prepared. And then the marketing plan, if you will, which would include advertising and getting into the portals and knowing how to talk to buyers, is also part of that preparation state.
Yeah, so you're kind of helping somebody step by step all the way through. No one's ever really prepared to sell their business, that there's always a preparation that has to go into it because you're trying to maximize what you can get out of that business. And I think that's a real benefit that you guys help businesses do that.
So another part of this is the emotional journey that buyers always
Okay.
go through.
Okay.
There's coaching that's involved with it. when
Okay.
we're going through the initial interviews. So the typical process is you go through the what I call the preparation of those documents, the evaluation, determining how you're going to go to market, and then the documentation around it. Once we find buyers, we'll go through a Q&A process and then ultimately make introductions to the seller themselves. And it's not unusual for me to see an evolution where we'll get on the phone, it might be a Zoom call, and the seller is so prepared and anxious to talk about their business. And sometimes it's hard to get them to stop because they're so proud of their history and how they got there and how exciting it
Yeah.
is. And I'm biding my time because I know by the fifth interview we have, they're going to be exhausted. The first one, we let them go, and I might have some consult afterwards and tell them that this is not the last time you're going to do this. And eventually it gets to the point where the seller learns how to talk about their business in a way that a buyer would want to, not in a way that you're trying to
Okay.
sell it. Because you're really not trying to open your coat pocket and say, I've got a watch to sell you. This is really getting into the honest aspects of the business, because I will tell you that once an agreement has been formulated, an initial one, which we call a letter of intent, then we go into a stage called due diligence. And in reference to your questions before about being prepared, due diligence is a really important aspect of this. It's allowing the buyer to look under the hood and really see and ask virtually any question about the business that they want to, because they're about to buy it. And if you really want to sell your business, you have to be open to that.
Yeah.
If you think about it, if you're going to buy somebody's business, you would want to know as much as you can about the organization, about the people, about the financials, about the equipment, about the customers, the inventory, the products that are manufactured or sold. So that is a whole other category of being prepared and open.
Yeah. Let me ask you this because I know this has happened before, but let's say somebody's going in to buy a business and they're looking to buy the business and it has, let's say, $100,000 in the bank account. They said, well, that I get that money, don't I? And they don't.
Well, sometimes, but you've hit on, we like to say that it dies three times, like it flatlines
Oh, tell me.
before
Tell
it
me about
actually
this.
sells. So, we're saying it's a deal actually has to die three times before it closes. And on average, that's about right. It's not always with the same buyer, by the way. Sometimes it will go flatline with that buyer. Other times it will end. But one of the reasons why a deal will die is because of what you just talked about, and that's this category called working capital. And without going into the boring part of it, it's basically saying the business needs a certain amount of operating capital to continue operations. So there's got to be a certain amount of inventory. There has to be a certain amount of, let's just call it cash, to generate the income that it does generate. Otherwise, not only are they buying the income, they're having to start over and fund the business with what's called this operating capital. So the typical way is to calculate what's called a net working capital. The seller will always keep their cash, but you come up with a formula that's based on current assets. This is really boring, minus current liabilities. And that number is what a buyer is going to assume is available for them going forward.
Okay.
Bottom line
And
is,
typically they,
you can think of it as like going into the grocery store. The buyer will say, hey, look, I need that cash in the till to operate. And a
yeah,
seller says, I've already earned that money. That's mine. And you know what?
yeah,
You can sympathize with both sides. It really, in the long run, adjusts the purchase price up or down.
yeah.
But I can tell you, quite frankly, it's always an issue of discussion.
Got it. Got it. And so do you typically go in and set expectations for both sides on that?
Yeah, it really depends on the size. We like to do what's called cash-free, debt-free, meaning that the seller takes all of the cash. We may negotiate taking all of the accounts receivable, and they take care of all of the liabilities. So that when a buyer comes in, really all they're doing is buying the assets. the inventory,
Yeah.
the equipment, the customer list, et cetera. That's the cleanest way to do it. But when you get into larger deals, the buyers who do this on a regular basis will expect there to be what's called this net working capital to hit it up front, because we don't want the deal to die, at least to set the expectation. So
Okay.
sometimes the buyers will, or rather the sellers will be completely resistant to the whole concept. And it's a difficult conversation. And other times they'll say, okay, I get it. If this is the way it's done, then I'm going to adjust my price accordingly.
Yeah. Yeah. Now, you've got big businesses you've sold, small businesses you sold, and then you have your sweet spot. So, give me a little bit of the range. You know, what's too small for you, and I guess there's nothing ever too big. But what's your sweet spot? Small, big, sweet spot.
Yeah, so that will vary greatly, but the smallest businesses that we typically sell go for around $1 million. There's so much fixed expense that goes into providing the level of services that we do. And so it's kind of like Pareto's principle. The smallest 20% will give you 80% of your work, a buffet of work, as I will say. But the largest, there actually are sizes that are meant for teams of people where smaller groups like myself, it wouldn't make sense. And that's where you approach maybe $100 million or more. So
Okay.
our sweet spot is typically in the $5 to $30 million range.
Got it. Got it. This is good. This is good. So if somebody was wanting to connect with you and start the process, what are some of the first things that they need to do? They make a phone call, and then do you have a initial meeting, conversation? Do you have them fill out a form? How do you start the process?
Yeah, it's very casual. This is not a high sales situation. A meeting via Zoom is very appropriate. A good conversation about what their interests are. As I said before, I want to know personally what their intentions are, what they want to do afterwards if they have the vision, because this is like a marriage, if you will. It
Yeah.
can take some time. We want to make sure that we have some good compatibility. But yeah, an initial meeting, and we'll kind of take it from there. It's all customized. It might be another meeting. We might be ready to go from that point forward. They may need some time to think about it.
Okay. And then if you're going to set expectations, let's say somebody has a $5 million business, they're looking to sell it. What's the sweet spot as far as time frame? Is it, 18 months, a year? How long does it usually take?
Yeah, there's a range, of course. I'd say the soonest a business can be sold is a 6-month time frame, because there's a lot of preparation involved. And we identify the buyer, there's negotiation, and then there's what's called the due diligence phase, and establishing the definitive agreements, and then ultimately closing. Depends on how it's going to be financed. So I'd say the earliest would be 6 months. On average, it's a year to 2 years, and the longest is never. But I've had sales that have been in the 2.5 to 3 year range. Of course, you want to do
Yeah.
it sooner than later, but that's one of the reasons why preparing now is never too early, because you never know how long it's going to take, and you never lose the contacts that you make during that process. You only
Okay.
gain more valuable information.
So if I have a business and let's say it's $5 million, I'm getting ready to sell it. I set an expectation that it's going to take me at least a year to sell it. And you're going to be with me that whole year doing due diligence and all that stuff that you need to do. What do you guys get out of that? I mean, is it just a percentage of the business, or do you charge them an hourly rate, or how does that work?
Yeah, that'll vary across the industry. We charge a success fee, so we only get compensated if we sell the business, and we get more, obviously, based on the higher the purchase value. That's how our compensation works. We do ask for defrayment of certain costs in the beginning. We call that an engagement deposit, and that is actually given right back to the seller on the sale of the business. So our compensation is based on success.
Okay. Okay. Well, that's good. Well, any other thoughts? We're about out of time. Any other thoughts that you want to add in? Any questions that I didn't ask you, or say, oh, this is very important that the seller should know, other than contact you?
I'm happy to talk. There's so many different aspects to it. I think the biggest takeaway here is that you don't want to go it alone. There's so many unforeseen circumstances that could occur that having somebody to guide you through it is essential, because you will lose and leave money on the table. And quite frankly, it's a very bumpy road. We
Yeah.
never anticipate or know where the potholes are going to be, but we're pretty much the shock absorbers for the whole process.
Oh, I love that analogy, just to have a shock absorber. I have enough stress as a business owner running my business. I don't need any other added stress. And if I can defer some of that off of you, or just have a shoulder to cry upon, that can be a wonderful thing.
When we have another moment, I'll tell you a story about a fella who was at the end of his career. And on the day of the close, I was in the hospital with him. He's okay now, folks. Putting on his pants, saying, "Stephen, we have to get to the close so that you can sign the documents and get wired the money. We'll do it."
Wow, you'll even put on their pants if they need to have their pants, and do the hospital escort and hospice care, all that. Yeah, that's great. Well, Joe, it's been a pleasure. I really enjoyed talking to you. If you have any questions or need to sell your business, then should be links around this video that allow you to get in touch with Joe. So thanks again, Joe. I appreciate you.
Thanks for your time. I enjoyed it.